A takeover proposal that promises a hefty premium often signals opportunity. But as the details unfold, a stark question emerges. Did KKR just find a bargain, or is something crucial being overlooked? KKR, a global private equity powerhouse, wants to buy up to 40% of FGEN Corp, one of the Philippines' leading power producers, at 35 pesos per share. For investors, that's more than double the stock's recent market price, seemingly generous, especially in a thinly traded stock. Yet, when set against another looming offer for FGEN's geothermal business, the deal reveals a valuation gap that's hard to ignore. Here's how the numbers stack up. Recently, Barreto Renewables Energy floated a separate takeover proposal for Energy Development Corp, FGEN's geothermal subsidiary. Barreto's indicative, non-binding offer valued EDC's equity at about $5 billion, roughly 308 billion pesos. FGEN holds 45.8% of EDC's economic interest, translating to an implied value of 141.1 billion pesos. Spread across FGEN's outstanding shares, that's approximately 39.22 pesos per FGEN share. KKR's proposal values the whole company at 125.9 billion pesos, or 35 pesos per share, 4.22 pesos below the value of its EDC stake alone. In other words, FGEN's vast portfolio of gas, hydroelectric, and pumped storage assets are being assigned a negative value when benchmarked against Barreto's offer. Beyond EDC, FGEN maintains a robust lineup, a 40% stake in its gas power business, which contributed nearly 4 billion pesos in earnings this year, hydroelectric generation bringing in over 1.8 billion pesos in net income, and pumped storage projects aimed at stabilizing the country's growing renewable grid. These are real assets, with operating performance and strategic potential. So why the discount? KKR's move secures substantial embedded gain, acquiring shares at below the sum of the parts value. Theoretically, at Barreto's valuation benchmark, KKR's newly acquired shares would grant more value than the purchase price, not counting additional assets. But there are caveats. Barreto's offer is preliminary and non-binding, and FGEN carries sizable obligations, including large capital commitments and a drop in cash reserves. Dividends from subsidiaries aren't guaranteed to reach FGEN quickly, and operational risks remain real. Discounts in valuation are justified by uncertainty and execution risk. Yet a negative residual value for all assets outside EDC raises concern. Is the market price so depressed that even a premium fails to reflect the company's true worth? KKR's proposal, though preliminary and not capable of acceptance, forces shareholders to weigh more than headline numbers. It offers clarity to public investors and liquidity to the parent holding company, but leaves a pointed question: who is paying, not just for EDC, but for everything else FGEN brings to the table? In the end, this isn't just a story of premiums and discounts. It's a test of strategic vision, one where every asset, risk, and opportunity should be counted before the final tally is struck. Ask yourself, are FGEN's hidden values set to be revealed, or quietly given away in the bargain?